30 fund managers, the other half of them are ahead. This episode is a monster. Again, amazing insights. I can't wait to listen to them again because we've already recorded them. How good were the first half of the fund manager predictions for 2026?
They were incredible, mate. And part two, just as good. We've got a lot on the docket though, so we've got to run through things.
30 fund managers, the other half of them are ahead. This episode is a monster. Again, amazing insights. I can't wait to listen to them again because we've already recorded them. JD, before we get to the very intelligent fund managers that everyone is here to tune into, we've got two quick things for the money miners to know about as we head towards the end of the year. First one, I don't know if all the money miners know about the Director Special. The Director Special is a daily email, markets-focused email that we write every morning. It goes out around the time that markets are open. You and I summarise all of the intel that is out from the market in the day, plus all of the headlines out from the Fin, Bloomberg, Reuters, all of the big stories in mining markets that day.
And we break news as well, mate. The Battle of Bankan has been unfolding right in front of our faces. Perseus, Predictive, and Robex, and that's just one of the many stories that we've broken over the past year since we kicked this thing off. So
sometimes we get a scoop which is markets relevant. We very I think it was a coincidence this week. We just happened to predict the exact recut deal split in the Robex, Predictive, Perseus battle for Bankan. My God, there's too many P's and R's.
We did. Long story short though, mate, look in the show notes, whether it's on YouTube, Spotify, or Apple. Right at the top, you'll see Director Special. If not, if that's too hard, moneyofmine.com. You can sign up right there.
Sign up. It's as easy as that. And
we're getting creative, mate. We might have a little treat drop in your inbox over the weekend. So keep your eyes peeled for that one. Second service announcement, Brewdog, 5 p.m, West Perth. Tuesday, I think it's the 16th of December. Come down, have a beer with us, have a beer with a whole bunch of people in the mining industry. We are pumped. Not much more needs to be said on that one.
Not at all. I'm keen to see the money miners in person, mate. Very keen.
Me too, mate. Now, before we jump into a whole bunch of commodity mining picks, and boy, do we have a lot to get through, we've got a little diversifier for the money miners. I'm talking property, mate, specifically Exceed Capital.
You're going to exceed my expectations with Exceed Capital here,
Exceed
mate.
Capital, they're the ones that'll exceed your expectations, mate. Exceed Capital have been around for a while. They've got a solid long-term track record. They're a Brisbane-based group. They run a bunch of different funds. Their flagship fund is the Collective, and they target a sort of 7 to 8% cash return paid monthly.
So this is commercial property in a fund that is accessible in units. Interesting. I thought you had to have like $1 trillion for a deposit on a house these days. Mate, you can get access to commercial property in any way, shape or form. It can be a fund and it can be pay a divvy and get capital uplift on top of that. Very, very attractive.
Very attractive. Details are in the show notes. Thank you, Exceed Capital. Now here we go on to the predictions.
Dave Sparks of First New York, thank you so much for coming back on the potty and giving us your 2026 predictions to kick off. What's your highest conviction call for 2026?
Okay, so I have a couple ideas here. Highest conviction is Q2 metals. Lithium, spodumene play in Quebec, proving out a tier 1 resource base. I think there's a huge re-rating potential coming next year. Initial resource gets defined at the beginning of next year, and then moving to the preliminary studies. I think I don't know if this is consensus or not, but I feel like the tide is turning a little bit on lithium. And when I look at like what Bloomberg has priced in forward estimates, I think that is the kind of contrarian commodity call in that the prices are still too low. So Q2 is highest conviction, followed by PMET, also in Quebec. I think there's a huge re-rating potential there after their feasibility study was only focused on one deposit, and you didn't get the benefit of seeing what the cesium and tantalum were worth. They still have to define what the gallium looks like. So the two Quebec up and comers I'm very excited about. And then I would say two honorable mentions. One is McEwen. So big copper project in Argentina that's going to get IPO'd at the beginning of next year, partnered with Rio and Stellantis. And I think obviously copper is very hot right now. Copper development projects are very hot right now. I think there's a massive re-rating potential coming in McEwen, both from the copper assets and from their gold assets. Really positive, encouraging drilling lately that's going to extend life of mine, and I just think the assets, the total group asset base is just entirely mispriced. And then final conviction idea, kind of like a free option here with Runway, is Algoma Steel, Canadian steel producer that is transitioning from blast furnace to brand new state-of-the-art electric arc furnace, has been destroyed because of US-Canada trade tensions. But Canada's given it $500 million in Runway. And they're pivoting from coil to trying to do more structural and plate, and Canada's trying to help them with infrastructure there. But you essentially are sitting on a free option to US and Canada sorting out a trade deal. The tariffs going from 50 to 15%, and this thing's going to massively re-rate. So those are the four I'm most excited about.
4 picks. I love that. Thanks, Dave. How about your most non-consensus view for the coming year?
Well, I don't know if lithium is non-consensus or not. You guys are going to know better than me with people jumping on here and giving their picks. I still think it is. I think from if you're talking an equity perspective, I know we talked about this name earlier in the year, and people still love to crap on it. But I think with where spodumene prices have gone, Sigma is a very non-consensus long idea at $10. I think where spodumene has now gone, the cash concern has to diminish. And, if we're 12 months from now talking about spodumene having been here or improving, then Sigma's made money. And we're talking about a phase 2 that's been financed. And then, December 2026, are we looking at a free cash flow yield on phase 1 and phase 2, and that's probably more of a $30-something stock than a $10 stock. So that would be I feel like fairly non-consensus, but you guys are going to have a better handle on that than me.
Great to hear, Dave. And what about the best performing commodity?
Well, I'll stick with lithium. Just thinking about, when you guys asked me, I was trying to think like, okay, what can really move the most? If we're talking about lithium doubling, I would, spodumene doubling from here, I would totally buy that. Carbonate, maybe, sure. But other than that, I think silver has another chance to double next year, given how tight the supply and demand fundamentals are there. And then I would say honorable mention is oil. I am very interested in looking at how to get 27 upside optionality to crude prices.
Mm-hmm.
I like your thinking there, Dave. And last but not least, what is going to be the worst performing commodity?
Okay. I gave this a lot of thought. I feel like everyone's going to say iron ore. year in, year out. I don't see why that's wrong, but so I'm going to answer this slightly differently. It looks like a great year for commodities coming up. I don't know that the themes that people are excited about are necessarily going to be wrong. I think copper does work. However, the thing that's going to nuke people's portfolio is going to be an AI scare. And if AI ends up blowing up the stock market next year, and we have to change growth assumptions, that's obviously going to have a negative impact on copper and the things that we like. So I would say, rather than like the worst performing commodity and what I want to be short next year, I think you want to be long the right themes and long a bunch of NVIDIA puts, because I think that's how your portfolio could get wrecked.
Chris Judd, Cerutty Macro Fund. We are stoked to get you on the show again, mate. You had some very good picks. Your fund has been roaring this year, so looking forward to what you've got in store for us for 2026. What is your highest conviction prediction for the coming year?
My highest conviction prediction for 2026, broadly speaking, is that the upgrade to the US electrical grid will be the number one most important issue in financial markets and the economy. And we think it's imperative that the US does this if there any chance to win the AI race, which has both economic and national security interests. And a stock we think is a good way to express that trade is IKE GPS, which is a locally ASX listed company that provides software and hardware solutions to US-based utilities in terms of supporting their pole infrastructure.
I like it, Juddy. And what about the most non-consensus call for the year ahead?
Look, so we know it's a commodities podcast and we're bullish commodities in 2026. Having said that, we think oil on a relative basis will underperform compared to other commodities. A lot of the smart people we follow think oil has some catching up to do, and they're really constructive on oil prices into 2026. People talk to the oil to gold ratio, which is historically incredibly high compared to historically averages, and many people that we really respect are predicting that to sort of whipsaw back into long-term averages, which would be good for oil prices. But we think there's political impetus between MBS and President Trump to keep oil prices low to the midterms. We think some of the decisions by Saudi Arabia, in effect OPEC, to boost production has been unusual when we compare it to past circumstances when the supply and demand fundamentals are as they are in the oil market. And we're not sure what the trade-off is for Saudi Arabia, what they're going to get in the long run, but we think there's a political will to keep oil prices relatively stable and underperform other commodities up until the US midterms in November 2026.
Yeah, cheap oil tends to keep the punters happy. So what is going to be the best performing commodity then?
But we feel we're a little bit late to this one, but we think silver is going to be the best performing commodity in 2026. And we say that whilst understanding it's had a really strong run in 2025. We're constructive on gold prices. When we look at previous cycle highs of gold being around $2,000, and gold's now more than double that in US dollar terms. Silver, its previous cycle highs were $50, and it's now, what is it today, about 16% higher than that. So we think it's got some catching up to do when compared to gold. And we also think the industrial applications or use cases for silver are really strong. Things like solar, EVs, electronics, medical equipment. We think there's strong demand heading into 2026 outside of the fact, outside of the people or groups that are using silver as a monetary metal, and particularly in countries like India, silver's a really acceptable place to store value, and we think that's going to be one of the things that underwrite its price in 2026.
I like your thinking. And the flip side, what's the worst performer?
So again, I'm repeating myself a bit, but whilst we don't think it's going to perform badly necessarily in nominal terms, but on a relative basis compared to other commodities, we think iron ore is going to continue to be relatively soft. We think the Chinese property market is in structural decline. We don't think it's a 1 or 2 year event, the softness in the Chinese property market, and then I guess by default, the softness in Chinese steel production. And this is happening at a time when Simandow's coming on board. I think it's starting with in 20 million tonnes per year in 2026, ramping up to 120 million tonnes by 2030. So the supply side for iron ore looks pretty healthy, and the demand side to us looks relatively weak. So we think iron ore will continue to underperform compared to other commodities next year.
Warren Irwin, Rosseau Asset Management, delighted you can join us again. Got to ask you, mate, what is your highest conviction prediction for 2026?
You know, in my world, in the world we live in, it's tough to have any high conviction, but my highest conviction would be with Colonial Coal. It was my highest conviction last year. It didn't happen, but super high quality met coal, lots of it, Western Canada, good valuations, on rail at a port. It's gonna perform very well here at some point, and I think with all the activity in the met coal space, it'll eventually get picked off. So that's probably my highest conviction trade in the coming year.
Looking forward to seeing how that one goes, Warren. How about...
Yeah, me too.
Fingers crossed.
Yeah.
How about your non-consensus view for the year coming?
Oh, I'm not sure what consensus is. That's the biggest problem with non-consensus views. But if the consensus is EVs are our future, you know, I don't share that view. It may be in our future at some point, but you know, EVs here in Canada are, you know, for a lot of people, they're just not usable. The cold weather reduces your range, and where I live, a lot of the mountains, you know, you can't tow with them. It dramatically reduces the range. So I'm not saying anti-EV. I think but anyways, I'm anti-EV. We've got even Ford's recognized this, right? I think they've stopped manufacturing the Mach-E and the Lightning, which is the Ford F-150, the most popular vehicle in North America, and they're no longer making the electric version of it. So it was kind of a slap in the face to Ford. But I think people they don't believe the baloney. And if you're trying to reduce carbon, it's not the way to do it. As you guys know, the carbon footprint in all the copper mines in Chile, Peru, wherever it's being mined, you're just moving the pollution from the cities in let's say Los Angeles or San Francisco to Chile, where they'll be burning all the diesel fuel down there instead of in the town. So it's really just a movement of pollution. And as far as CO2, it's a lot of work's been done on this. The CO2 savings by going with electric is over the lifespan of a vehicle it doesn't work. And so it's pretty ridiculous. The vehicles don't work in Canada for a lot of people. They do for the people who just, you know, travel around the cities and stuff. But if you're going on long trips or have mountains, or if you're in Edmonton or Calgary where the weather's super cold, they just don't work. So that's my my non-consensus view. And I think we're starting to see it collapse. People just aren't buying them. That's why they've stopped. Ford shut down a lot of their EV production.
What is going to be the best performing commodity for the next 12 months?
I got to think met coal. I'm a big fan of met coal. Nobody's looking for it. It's really, you know, nobody's looking for met coal. 1,000 people are looking for uranium and gold and everything else, but nobody's looking for met coal. We've got the Indians. I'm not sure if you looked at their steel production figures. They want to double the steel production within a very, very short period of time. And they're not going to do that without met coal. And there isn't the slack in the system, in my opinion, for it. So we'll see. And so I guess I'm pretty bullish on met coal. The reason I like it too is it's out of favor. I think a lot of people have been anti-coal. I think again, not unlike EVs, people are starting to put their thinking caps on and figure out that you know, coal is not going away, as oil is not going away. And so a lot of these themes that were playing out, you know, 3-4 years ago, I think people are starting to realize how ridiculous they are.
Yeah, certainly contrarian there, Warren. Last year, you served up uranium as the commodity to not exceed the other commodities that we look at. What are you going to pick this year?
Well, as you know, the uranium was pretty much flat. I was against the curve, against everybody who was bullish on uranium, expecting 100, 150, 200 uranium. So, and there were the reasons for that is, here, we talked about it last year. Basically, you had a lot of baloney in the market. And despite all the market manipulation, we're talking serious market manipulation, not unlike trying to corner the silver market when I was a kid. I remember the Hunt brothers trying to do that. Well, when you had Sprott and Yellowcake trying to corner the market in spot uranium, a very illiquid market, and despite buying about 100 million pounds, and all the speculators on top of that, they still haven't been able to squeeze the market above 100 or anywhere near the $200 level targets people have. So I'm not super duper bullish on uranium. I do own uranium stocks, but we got to get the uranium's coming from somewhere. Nobody knows where it is. It seems to be filling the production versus consumption gap. So until we start seeing signs of that ending, I'm not a super big bull on it, although I wish it would go up because they do have the world's largest undeveloped uranium project in Sweden in District Metals. But that being said, once again, being contrarian here on the worst performers, I think this whole critical metals thing is total baloney. And again, I own one of the world's most significant critical metals projects, but I think this whole critical metals thing is overhyped. I don't see how we're going to make any money on it other than in the stock market. I don't think it's going to be tough to make money actually running a critical metals operation. But I think, on the hype, I might be able to make some money flipping it off to people who believe the hype. But I'm just not a big fan of critical metals, and I think at some point, it might be this coming year, 2026 or 2027, where people finally realize it's just completely overhyped. And the businesses themselves, the reason we don't have Western production is it's tough to make money doing it. So we'll see if that happens, and we'll see to what extent the Chinese continue to hold back on critical metals. But that's sort of my take there. Again, contrarian. The other one that could be kind of fun, and I actually don't believe this, but I'm bullish on gold. But given how good a run gold had last year, a contrarian like myself would say I think gold's going to be the worst performer. But frankly, I don't believe it. One thing I think we get all the biggest thing in our business, and I've been doing this for many, many decades. The only thing we could count on for sure, 100%, is our idiot governments printing money like crazy and devaluing our baloney paper currency. And you're seeing that in Canada, you're seeing it in the US. So the value of gold will go up without a doubt over time. I'm calling the $5,000 an ounce gold. Don't know when it'll happen, but it will happen within my lifetime, hopefully. And but the one thing we can count on is these politicians printing more and more money, and gold long term will do great. It might have a setback over the next year. It's had a good run, so we'll see what happens there. But I look forward to 2026. Should be fun. I hope I get Colonial Coal sold.
Michael Teran from Blackwattle. It's been a while since we've spoken, mate, but I'm delighted that you're joining us for our predictions for the year ahead. To kick things off, what's your highest conviction prediction for 2026?
Hey guys, great to chat again. Thanks for having me on. Our highest conviction idea in the mining space for 2026 is that NextGen gets taken over. We just think that NextGen's Rook project it's too important, it's too strategic just to be developed by an independent. Like, this is a tier 1 resource. At full run rate, it could be doing 30 million pounds a year, and that's in a market that only does 160 million pounds. That would be pretty disruptive if that came on pretty quickly. So it just doesn't make sense for it to be done by independent. It's large enough to be bigger than Cameco, right? And so we think the big catalyst for 2026 is that NextGen they get their federal approval done by mid-year, and we think at that point it's a sitting duck. Most likely Cameco consolidates them. It's a generational opportunity for Cameco. Like, this locks them in to be the preeminent supplier, Western supplier. So we think that's a high probability that NextGen gets consolidated.
Fantastic. I like it. How about a non-consensus pick?
Yeah, okay. Going a bit out here, but our contrarian call is that debasement trade just really accelerates in 2026. And that's driven by the US. Look, the US fiscal situation just gets worse. Deficits heading towards $2 trillion a year. You got midterm elections next year. That probably means more tax cuts, more spending. Trump is looking to replace Powell as the chairman, and all those candidates are really, really dovish. So more rate cuts. And contrast that with the current economic environment. You've got, US nominal GDP tracking 5% plus, core inflation 3%. I mean, this only makes sense if you're doing this to, try to run the economy hot and, debase your nominal debt. And I'm not saying the US is the only one that's like this. Even here in Oz, we've got, core inflation above RBA, target bands, and, they're still pretty dovish. So we just think, 2026 is that inflection point for that debasement trade. And, you really want to own real assets to, protect your purchasing power. And that's why we're pretty bullish on commodities for 2026.
I like to hear it, Mike. And of those commodities, which one's going to do the best?
Oh, we can't have a conversation without talking about lithium.
Yes.
Still
Okay.
a lithium pool. And, look, we think the lithium party is just getting started, and 2026 is where it really pops. Lithium is a really immature market. We've had, two really deep bear markets and a big bull market in between, and just that's in the last 5 years, right? And that's because it's so immature. And I know pricing has recovered a bit from those low levels in the middle of the year, but at that point, pricing was unsustainable. It's below short run marginal cost. You were forcing, mothballing of production. And for producers to bring that production back online, they need a really strong price signal. And there's a bit of a lag before they can decide to bring that online anyway. And demand just continues to compound away 20-30% with battery storage going strong. And so you can see this really big flip from surplus to deficit into 2026. And in such an immature market, that should mean a price spike. And so we think 2026 could look like 2022 with this big price spike somewhere in there in a point. And I'm not saying that's a sustainable level. And it probably sows the seeds for the next bear market. But that's what happens in a very immature market.
Fantastic. And if you put your bearish hat on, what's not going to perform for the coming year?
This is a hard one for us because we're pretty constructive commodities across the board. So we think this is more of like maybe a relative underperformer, something that stays a little bit flatter for 2026. Maybe iron ore sort of drops in that bucket. Demand's still pretty sluggish. You're sort of waiting for Chinese stimulus. Simandou starting to ramp up. So it's hard to see that price really move without some decent stimulus. And so a flat price for iron ore means it's probably a relative underperformer.
Sam Broom, Sprott, it's been too long since we've spoken, but I'm really excited to hear what you've got for us in store today. What is your highest conviction prediction for the year ahead?
Good day, guys. Thanks for having me on again. Always a pleasure. There's a fair few setups this year, so it took me a little while to settle them down onto what I wanted to go with. But in terms of what I would say is my highest conviction on having a decent year next year, maybe not the best performing commodity, but one that I think's set up to have a high percentage chance of doing well next year. I'm going to have to go with copper, which is probably a consensus pick at this point. I'm sure it's not going to surprise anyone. But in terms of the share fundamental setup, you've got a already fairly tight market. Predicting modest deficit next year, and that's assuming some big mines like Kamoa-Kakula, Grasberg, QB2. That's assuming some issues on those assets get partially resolved. It's kind of like an upside case on all of those assets. So if we see a little bit of a miss on any of those, along with a demand outlook that to me looks a little bit conservative, I think barring some sort of economic event that really derails things next year, I think there's actually a little bit of upside to the demand scenario. So again, it's probably not going to be the best performing commodity, but in terms of commodities that have the highest probability of going up next year, I'd probably have to go with copper. I mean, you just got to load up that chart too. I mean, it reminds me of gold circa kind of March, April of 2024, right? Just sitting right on the cusp of this big multi-decade breakout. It looks phenomenal. I look at it and I just think it's hard to look past copper for next year.
Beautiful. If I have one quick follow-up there, because we saw a lot of divergence between LME and COMEX copper in the past year. You're based in America, so are you betting on the COMEX or the LME?
I'd buy. I mean, I tend to not look at the COMEX just because of that distortion from the big, tariff spike north of 6. So I think the LME chart's a lot cleaner, and a lot. It's kind of the more global picture, right? The US is going to have distortions, you know. So I tend to look at the LME chart more than I do the COMEX chart, despite being a yank based over here at the moment.
Fantastic. Okay, what's your non-consensus pick?
Non-consensus, I went with energy, you know, traditional energy, oil and gas at the moment, which, you know, especially in the PA, I've been finding myself nibbling away at the most at the moment. You look at the positioning, right? Everyone's pretty bearish. I mean, the managed money's, you know, more bearish than peak COVID. You know, you got to go back to almost the global financial crisis back in 08 to get similar levels of market positioning amongst the speculative money. You know, again, it's kind of the opposite of copper. It's like everyone's positioned for worst case scenario on demand, you know, oversupply. I just think, you know, it may not be the best performing commodity next year, but I think the risk reward is quite good here. So, you know, high quality oil and gas names, you know, is where I'm finding myself nibbling away quite a bit at the moment. I just think $60 a barrel's anywhere near these current levels is not going to stick around for, you know, at least into the mid to long term.
Preaching to the converted, mate. What is going to be the best performing commodity for the 12 months ahead?
Again, it's usually these weird little obscure commodities, right? I was dead wrong last year. I think I said vanadium was going to be. So I'm denied on this one.
I liked your creativity though. It got me more interested in the vanadium market.
Well, I'm going to double down on red, and I'm going to go vanadium again this year. I think perhaps I was 12 months too early, and specifically the US pentoxide price. You know, talking to some people that know the space, you know, it's very opaque. It's very hard to find information on, but you know, it sounds like it's almost impossible to buy the physical on the US side here. You know, Brazil, for example, was a big provider of high purity pentoxide into the US market, and you know, they just will lock 50% tariffs on that coming in, which, you know, was kind of like a, you know, when it rains it pours moment for production out of Brazil. I just don't think it'd stay this way this long without something material changing. It's a very small, very opaque market, but it's, you know, we've seen what happens when these markets get kind of supply constrained, and there's a, you know, sort of almost a price insensitive buyer, which especially for the high purity stuff is the case in vanadium. So I'll go with vanadium. You know, another kind of obscure one I toyed with was indium. You know, I know internally there's interest in indium. Again, another small opaque market, but there's some interesting developments in China where they've looked like they've developed, you know, a new semiconductor that is an indium selenide that they've been able to mass produce and looks really, really good. That could be an incremental, you know, more than an incremental new demand for it. Then on top of that, I mean, in the US imports 100% of its indium, right? So it's one of those kind of fits in the critical bucket that they're screwed. There's no internal source material. So I have a feeling it could do kind of a antimony or a, you know, tungsten or something and go on a hero spike next year. We'll see.
Looking forward to seeing that. And what is the commodity you're most bearish on?
This is a bloody hard one because so many of the setups look enticing, don't they? I feel like a bit of a cop out, but I had to come down to, you know, what's probably going to go up the least, because I get the feeling, you know, just with the setups out there, that a lot of stuff's probably going to go up next year, you know, particularly if the dollar really does roll over, which I think it will. But I ended up going with nickel just because you pick up all the charts, it's just dead, right? I mean, the poor nickel market there's just still so much supply out there. It's just like capped at this, you know, kind of $14,000-$15,000 a ton level. I don't see anything obvious that's going to change that next year, with the caveat that there's always a geopolitical event. You know, even Indo's looks like they're trying to kind of reduce the future supply by tightening a few things up. So I don't know. I have a feeling that maybe in 12 months' time, I might go the other way and have it as a potential top performer, but just feels a little too early in the nickel market, absent something coming out from left field. So yeah, I'm gonna begrudgingly go with nickel. I want nickel to be cool again. But for now, I'm gonna have to pick that as my worst performing commodity for next year. So
Rodrigo Carvallo of BTG Pactual, we are delighted you've made the time to join us and looking forward to hearing your predictions. What is your highest conviction prediction for the coming year?
SQM share. We are really bullish on lithium market for next year. So SQM is a good vehicle to be there. At the moment, the company has a very good news flow regarding closing of the Codelco deal. We are expecting to have the closing of the deal by the end of the year. We just expect the internal audit of the Chilean government to approve, and with all of that, the share will rise in our opinion. At the same time, in terms of operational front, the company will grow in volume growth by 10% next year. So in a really good scenario of lithium is the company to be, because as you may know, the structure of contracts very spot versus the rest of the lithium peers with no too much caps or floors. So it's very interesting it's a symbol of lithium price in our opinion.
I like that pick, mate. And what is your most non-consensus prediction for the year ahead?
This is a bit tough, but I will bet on iron ore.
I like it.
I think the supply is very restricted. I mean, no many growth projects for the industry. The majors are, as Rio Tinto and BHP, are interested in growing in copper. So it's interesting to see that despite we have a slow demand in China, maybe we have a potential of a structural supply-demand balance better than the expectation of many years before. Simandou has been a disappointing ramp-up to get the volumes. So, and additionally, a topic that is interesting to highlight is the lower grades in the industry. Rio Tinto has showed an estimate of more or less 3.5% of decrease of supply as industry level because of this. So you have older mines, and it's a topic that is also affecting copper industry. So it's interesting to understand that even with a weak China, I think the market can be imbalanced.
Fantastic, Rodrigo. That is certainly one of the most non-consensus views we've heard. What have you got as the best performing commodity for 2026?
As I said before, I'm very bullish on lithium. I think the demand is been outperforming the expectation for many quarters. For sure, EV sales is been increasing, but the surprise is for the ESS side, growing over 70% this year. And if you analyze the data from the backlog of projects going forward, we could expect even an additional year with over 50% of growth in terms of demand.
Great to great to get that perspective. What about on the flip side, Rodrigo, the worst performer?
Another tough question, maybe nickel is a very oversupply market because, you know, Indonesia is very important. They have a very important cost advantage versus Western world, and lower regulations. It's at the same time, I think China is investing heavily there. So with the support of Chinese companies and lower regulation, to get a product there is very easy versus the rest of the world. And in this context, it's a market very complicated to be rational. So in my opinion, with the demand disappointing in terms of a demand of batteries with nickel cathodes. As you may know, that LFP is been increasing market share over the 3 or 4 last years. It's hard to predict a surprise on demand, by the way, so I'm not so interested in nickel at the moment.
Rob Mullin, Marathon Resource Advisors. We are thrilled to have you on the show again and looking forward to hearing your predictions for the coming year. What is your highest conviction bet for 2026, Rob?
So as like the dumpster diver value contrarian that I am, I love traditional energy here. I think, your oil and gas producers, there is so much egregious negative sentiment. The widespread belief that we'll be vastly oversupplied with the additional OPEC barrels that have come on. To me, that it just, positioning for, both specs and commercials, and everything is just loaded up to the negative energy side. And yet, over the last, 2, 3, 4 weeks, the stocks are doing actually pretty well. And so to me, that's the market telling me that there's a story here, that a lot of times the stocks turn before there is any fundamental sign of it. It feels to me like that's happening in energy. There happen to be some great ways to express it. And, look, when I was down on the other coast at Sown Hearts and Minds, my pick was Schlumberger. And so I know it's not the, 4-cent special that, has a couple billion shares outstanding that sometimes, people get excited about. But I think it's a spectacular story. It's got a resource component to it. It's got a technology AI component to it. And I just think it's one of those things that, to me, when you can buy super high quality businesses by, generating huge free cash flow with management teams buying back stock hand over fist at trough multiples on trough earnings, sign me up. Give me more.
It's simple when you say it like that, Rob.
Yeah.
What about your most non-consensus prediction for the year ahead?
So, I got a few. In the resource space, I'm actually not that psyched on natural gas. I think people have kind of come into this winter and are super excited, and you've sort of got the peripheral players from the AI data center theme who are they've over the last year, a couple of times they've kind of stepped into the resource space and have decided to, grace us with the fact that it's worth actually buying some of the stuff that you have to power all of these things on. But I'm just not sure I see it, and I don't, not yet, at least. And so I think this near-term push that's got U.S. prices, up for the winter close to $5. I think there's a lot of gas that can come on then. I think it's better for the service providers, quite frankly, than it is for the companies. And so, I'm kind of incrementally, natural gas for me is a big meh. And I'm relatively constructive across most of the commodity complex, despite the fact that I don't have a particularly aggressive economic stance. I'd say if I was going to throw one other thing in there for fun, I'm actually pretty bullish on the yen. I think the Japanese yen, and if I had to pick a currency to play it against, I'd actually be long yen, short peso. So Mex yen to me looks like a pretty easy kind of tail trade. You may end up making nothing on it, and but I think that is where global investors are so overloaded to one side of the boat in terms of being short yen. And if there is some sort of, tremors in the, global backdrop, whether that be, continued rough private credit or, anything else, geopolitical uncertainty, et cetera, that to me is something that looks wildly asymmetric. So that would be my other non-consensus is long yen versus Mexican peso.
Contrarian as always. What is going to be the best performing commodity? Maybe if we park up your energy bet for a moment there for 2026.
Yeah, I think putting that aside, actually, again, going into things that people hate, thermal coal. It's another one of those places that's acting a little bit better. And I think one of the realizations that the world is coming around to is that this perceived cliff of fossil fuel demand, whether it be oil, gas, or thermal coal, that the kind of people envisioned and were investing for at the 2030 and on, that dog doesn't hunt in a world where EM is going to continue to grow and need the best and most functional forms of energy. And in the developed world, AI data centers are going to cause the requirement that the grid grows, 2 to 3 times as fast as it has at any time in the last 30 years. So to me, that's just all of those, that sector in particular looks like it's been treated like a short-dated option. And I think you have to add 5 to 10 more years onto it. And so when you turn a 3-year option into a 10-year option, the price goes up a lot. And so I think that's where thermal coal is right now.
And the flip side, Rob, the worst performer.
Yeah, look, I'm not 100% sure I got really strong feelings on this, but if I'm kind of meh on the economy, and it does look to me like iron ore supply looks pretty full. That's a place where I'm incrementally short. Is kind of the iron ore and iron ore producers in an economic environment that is up a little to maybe down a little. That's an area where I don't think you get much juice on the upside.
Matthew Fist, Firetrail, the Aussie Small Caps Fund. You've been killing it this year. You had some great picks last year. You gave us the gift of Genesis for your highest conviction prediction, which has done remarkably well. What have you got in store for us this year?
Look, I'm going to go the same again, guys. It's be a bit of a theme through this chat, but I've got some specifics for you.
Tell
this
us.
year, Genesis, they're going to beat guidance by more than 10%.
Yep.
And they will show a clear pathway to over 500,000 ounces per annum.
Wow, I like it. That's doubling down, but the numbers just get bigger. And it was a great pick last year. What about your most non-consensus prediction for the year ahead?
All right, so I think one thing that's been a bit on the nose lately are the African golds. There's been a fair bit of political risk that's come into the names, and we've seen them all derate quite considerably. My non-consensus pick for this year is that we see a material re-rate in a lot of these names, currently trading on 0.5 times NAV versus the Aussie sector, which is anywhere from 1 to 1.5, depending on who you believe. And the key thing that's happened there in the past few months is the listing of Zijin. So Chinese company listed, now has a $200 billion Australian market cap, producing 1,500 ounces, similar to Northern Star, that's got a market cap of about 35 billion. So the key thing I think will happen there is Zijin will start being very proactive in terms of acquiring assets in Africa in particular, and that should see a material re-rating of the sector. We've never had a company like that that's got the capability to be able to acquire, and I think that will see the whole sector be re-rated over there.
Awesome. Looking forward to seeing that play out. And how about the commodity to do best?
Can't go past oil at the moment. I think the market is pretty much tighter than what the consensus would have you believe. We're seeing a situation now, I think, where the market is broadly balanced. No one in OPEC has got any spare capacity apart from Saudi and the UAE. On top of that, you've got over 90% of the capex in the US onshore now is being used just to sustain production rather than grow. Financial markets are at record levels of short interest. So I think that's just a great setup there at around $60 a barrel.
And the flip side, Fisty, the worst performer.
Yeah, I'm going to double down on NDPR here, guys. So I had a few nightmares when I was rekindling my prediction from last year and watching the line of share price go up and Iluka over the year was pretty tough for me.
Mm-hmm.
It's I'm doubling down here, and if I'm wrong again, I'll double down next year. My thesis there is that the amount of government support we're seeing is going to create an oversupply. Government's underwriting prices at $110 a kilo for the whole sector is clearly just not sustainable. And so I think it's just a matter of time before that price comes back down.
I've got a quick one for you, Travis. What do you reckon is the best way to make sure your company, if you're running a mining company out there, gets a shout out in the 2027 predictions in 1 year's time?
You got to perform well as a mining company, and performing well. Well, what is control the controllables, and what are the controllables as a mining company? Your costs. So I'd be focusing on them.
Exactly. And I think, if you're out there in your mining company, you're thinking, how can you do this? The answer's pretty natural to us, right? Switch technologies. That's how you can do it. Engineering solutions right here in the heart of Perth with their big warehouse in Northbridge, mate.
I very often have lots of ideas I wish I could have an engineering solution for, and turning those ideas into reality is something that these guys are the best at.
It's very true, mate. And engineering has a bunch of different facets to it. So just to be clear, we're talking about mechanical, we're talking about electrical, we're talking about software engineering. Every one of these facets, they are experts in. They can design the solution all the way through to the ultimate delivery of that solution, be it in machinery, be it an infrastructure-related thing, whatever your problem is on site, Switch Technologies are the solution you are looking for.
They've got a commercial outlook on these things, JD, helping mining companies focus on their costs, especially these times when the cash is coming in. You really want to make sure your costs are prepared for all sorts of markets. So get in touch with Switch.
Get in touch with Mike at Switch. Romano, Sala, Tenna from Katana Asset Management. You gave us some fantastic picks last year. I'm excited to see what you've got in store. What is your highest conviction prediction for the coming year?
We think that Next Gen Energy Canada, ASX code NXG, will actually get taken out in 2026. I think we all know the thematic around uranium, how good that is in the supply-demand imbalance. And added to that now, of course, is AI data centres and the huge growth in electricity demand. I think nuclear is probably the only way that you can really meet that demand. NextGen owns the Rook I deposit in Saskatchewan in Canada. It is the largest, highest grade uranium deposit in the world that's undeveloped. Saskatchewan is is ranked number 1 in Canada on the Fraser Institute for mining friendliness, number 7 globally. And to put a bit of perspective around the size of it, at full production, I'll be producing it around about 30 million pounds per annum, which is about 25% of global supply. And by comparison, Cameco is looking at about 20 million pounds per annum. Tier 1, $10 operating cost, which is because the grade's 10 times everything else, and a 13-month payback. Now, we think the most likely acquirer is Cameco, but we are quietly hopeful that, someone like a BHP or Rio, which is also in our portfolios, will think outside the square and actually want to add another string to their bow, a forward-facing commodity. It meets all the hurdles and take it out. But either way, I think, the final hurdle for NextGen is in February when they get the final hearing and then have the final approvals through. And as I said, in Saskatchewan is a very mining-friendly jurisdiction, so don't expect anything untoward. So we think they'll subsequently get taken out after that time.
It's actually, you're actually not the first person to predict that one, Romano. So we've got a trend already here. What is your most non-consensus prediction for the year ahead?
Well, you can make a case for a lot of things, can't you? I mean, certainly iron ore, that's stronger for longer and defies the analysts yet again. And also oil. I mean, oil has been in the doldrums for a couple of years. And, as we sit here today, it's almost impossible to see what a catalyst could be. And that's often when a commodity does turn, like we saw with lithium earlier in the year. But we're actually going to go with one that's in the portfolio, which is West Africa Gold, WAF. We think that this process in Burkina Faso has been traumatic for shareholders, but I think it's been more nerve-wracking than is the reality. I think, if you were to look at the worst case scenario, which is Burkina gets another 35% stake for nothing, you still get a $3.60 valuation on WAF, which is still well north of where it is. But we ascribe a 1 or 2% probability to that outcome. The government's come out and said it has to be mutually agreeable, mutually acceptable. And I think I wrote down a quote here, quote unquote, it has to respect the legitimate interests of all parties. So I think the most likely scenario is that they get 5 to 10% extra. They pay $50 to $100 million, so a fair price for it. But then they give WAF preferential status in terms of developing new assets. And that really is a much, much bigger win for Burkina because it creates a much bigger pie. You've suddenly got new operations, new taxes, new royalties, new jobs, and the flow-on effect from new jobs is really critical. And of course, you send the positive message that the country is open for business. So it becomes a win-win-win. I think, the government will see that that's a much smarter option than to try and squeeze the existing lemon much harder.
I like it, Romano, and looking forward to seeing Kiaka continue to deliver in the new year as well. How about if we look at the commodities to do best in 2026? What are you thinking of there?
I think last year we went with met coal and gold, and met coal was a bit of a stinker. It's pretty much tracked sideways for 12 months. But I think, gold, the fundamentals still remain intact. You've got two major drivers, de-dollarization and devaluation. BRICS are all looking to to move away from US as a reserve currency. That's going to continue. China's got somewhere between 2,300 and 5,000 tonnes of gold in reserve, 2,330 officially, but analysts think about 5,000. The US is at 8,000 tonnes. There's still a long way they can go before they meet equilibrium. And then devaluation, the big beautiful bill pretty much guarantees budget deficits around about 6.8% for the next 3 years. That's double GDP growth. So you're effectively devaluing your currency by 3 to 4% per annum. So who wants to buy a currency that's going to be down by 10 to 12% in 3 years' time? So central banks around the world have to find somewhere else to put their money. There's not a lot of alternatives. Gold's probably the standout.
And the flip side, Romano?
The worst one?
Yeah.
Yeah, I always struggle with this. Look, I have actually got one for you this year. I think mineral sands. If you look at past cycles, it's really been an oligopolistic supply side. Luca and the like have really controlled supply to match demand. And so they've kept prices probably higher than they otherwise would be. China's now into the supply side. There are countries running anti-dumping sort of cases against China, but nonetheless, I think the supply side is irreversibly changed. I think moving forward, we're going to see tighter margins.
Pete Prendiville, Norfolk Capital, absolute pleasure to have you back on the podcast and participating in our predictions episode for this year. What is your highest conviction prediction for the year ahead?
I think just playing on what's been successful for us over the last 6 months, probably rare earths still. I think it obviously plays a very important, vital role even in technological advancements. So AI, EVs, clean energy, robotics. And I guess within that rare earth space, our highest conviction prediction would have to be Mont Royal Resources and its Ashram rare earth project. And so that's at about a $45 million EV at the moment. And it's the largest rare earth asset in North America, undeveloped in monazite. It's got a big fluorspar component, high-grade fluorspar component as well, which I think will become even more important to that North American supply chain over time. So it's really an important asset for Canada and opening up that northern Quebec region. And it's probably even more important to Western supply chains as they attempt to disconnect themselves from China's dominance.
Beautiful, Pete. And when you think about your most non-consensus pick in the portfolio, what have you got?
Not too many this year round. I think it's a better commodity backdrop than it has been previously. But I think the one we've identified was lithium producers might be trading a little heavy for us. So I'm not sure how that'll go down broadly in Perth, but spodumene prices have gone from $580 to almost $1150 SC6. And from our numbers, we're seeing those key ASX lithium producers on average, they're priced at around $1,400 a tonne. So there's a bit of catching up to do there in the price, or something has to give a little bit on the valuation grounds for those producers. But, there is a little bit of that idle mine supply that still hasn't come back online from China, but we think that's more of an inevitability, and that will probably put some pressure on the prices and in turn the equities. But that being said, I think there's some really good valuation propositions in the massively beaten down exploration and development equities for lithium. It is a pretty nascent industry, so there is going to be a lot of volatility. It is hard to sit here and say that that's our non-consensus view, because we have been proved wrong before. But just purely looking at it from a valuation backdrop, I think it's those producers are trading a little above where we would expect.
I like your thinking, Pete. What is going to be the best performing commodity for the next 12 months?
Yeah, so we tossed up between rare earths and HPA, high purity alumina. And I think it was just too hard to walk away from rare earths. You've still got the China ban on exports. I know they've paused that for 12 months, but if you read the fine print, it's the ban actually still remains on rare earths that are exported for the purpose of strategic or military applications. So China's still got a bit of a stronghold and control on what actually leaves China. So how that unfolds, how that moves into a agreement is still unclear. But what is clear to us is that there is only two major rare earth Western producers and refiners, Lynas and MP. Those mines take a decade to bring online, and then even longer to process, create downstreaming capability, delineate, permit, construct, commission. And so the backdrop for that is positive for rare earth pricing and its importance in feeding that Western supply chain and the amount of money I think that governments will throw at it. Between EVs, wind turbines, AI chips, robotics, it's going to be hard pressed to find supply for Western worlds if China continues to stranglehold that sector. So I think rare earths is our pick still.
And what are you bearish on for 2026?
Bearish, as much as I hate to say it, it's probably cobalt. I think cobalt's had a great run. It's up nearly 140% since February. The price is still going up, but it's only being manufactured that way by the DRC. The export ban earlier in the year on cobalt provided a really strong supply restriction. And as that's starting to unwind, they've implemented this quota system which allows a certain amount of cobalt to leave the DRC, but it's continually being relaxed. And that supply is just building up in the background. You've got 290,000 tonnes of production of cobalt annually, and you've got around 210 to 15 in consumption, and that's also being chipped away at. I guess it's decreasing as the globe moves away from nickel, manganese, cobalt batteries towards LFP. So you've got supply coming back on, and the demand profile softening in our view. So that's probably our worst performing commodity.
YJ Lee, fan favourite of Arcane Capital. You've had a tremendous year, some great calls. We're very curious to hear what your highest conviction prediction for the year ahead is.
Hello guys, it's great to be back here. And okay, since we're jumping right into it, well, my highest prediction for this year, I think it won't come as a surprise to you. I think more and more brokers are going to switch from their negative tone on the lithium market to either a positive or even bullish tone. So this oversupply that they had been forecasting to last through to 2028 or even 2032 will just magically disappear. They're probably going to switch to balanced or deficit forecasts from even the start of next year. So what I feel is that a lot of these analysts, they are changing their narrative to explain the price. When the lithium price was at an unsustainable level in the middle of the year, nobody stepped up to say that energy storage was going to drive demand up and balance the market. Only after the price went up 50%, then they said, oops, sorry, we're not going to raise our price forecasts. Just 300%. So there we go. I think more and more analysts will still do that.
Changing the narrative to match the price. I love that. How about your most non-consensus view for 2026?
Well, there are a lot of people that are saying that copper is going to do very, very well next year. I'm seeing forecasts of up to even 13,000 per ton, and so I'm going to come out with a non-consensus one here and say copper could crash next year. Of course, I could be completely wrong, but what I'm seeing is a K-shaped economy in the US, and only tech and AI are doing really well. Everything is, really down. Consumer credit is at a record $5 trillion. More than 700 US large companies have gone bankrupt this year, and this is the highest rate since 2010. US truck demand is down 47% quarter on quarter. Construction, industrial, freight activity is all down. So there's a lot of negative economic news that's just being ignored by broad markets, which have surged to record highs and are staying at record highs just because maybe because of the incoming rate cut, but mostly just held up by tech and AI.
It's a pretty stark observation. YJ, what is going to be the best performing commodity for the year ahead?
Well, I'm not called the raging lithium bull for nothing. I'm sticking with it. No, but if you had asked me this question last year, I would have said silver first, then lithium, because I did see that silver was going to outperform faster than lithium, and I think that really happened. This year, I'm going to flip that around, and I'm going to say lithium, then silver. So, no, I'm not kidding. So I can see a scenario with a very decent probability where lithium goes to about 200K Chinese yuan, and that would be more than 100% up from where we are today. And I think that's not just a low probability event. Silver could go to $100 an ounce, and that's from where it is at 50 plus, low 50s today. That's just under 100% upside. So I don't see many other metals markets that could have this potential range unless they are really small volume niche metals.
Yeah, I like the conviction you have in your views there as well, YJ. And the last but not least question, what are the commodities or commodities specifically that you think won't do well?
Again, probably going out on a limb here, I'm going to say oil. Because I think everyone is still underestimating the amount of demand substitution that's happening, not just because of EVs in the passenger vehicles, but also in electric trucks. So the truck theme has been something I've been pounding on for the lithium market. I first started pounding the table on energy storage and then trucks. And look, the numbers out of China are quite amazing. 22% of all trucks, heavy trucks in China in the first half of the year were electric, new sales. CATL is pushing for 50% of all trucks to be electric by 2028. Now, this follows, the pattern of high volume users transitioning to EVs first because they make back the money from not burning diesel or petrol so much quicker. And by virtue of them being high volume users, the oil demand impact is much, much higher than the vehicle number new sales suggest. Consider that taxis drive 300 kilometers a day versus a typical car's 50 kilometers. That's a 6x impact of a single new electric taxi being sold than a new passenger car. So what's happening on the bigger picture is that many of these high-use freight vehicles, whether they are commercial, large trucks, or taxis, they're going to account for a much bigger volume of oil demand reduction than most people realize. And I think that hits the oil market sooner than people think.
George Cheveley, 91, you are the portfolio manager of the Global Gold strategy as well as co-PM on the natural resources strategy. We are delighted to have you on the show, and I'm looking forward to hearing what your highest conviction prediction is for 2026.
Yeah, thanks, guys. It's great to be on the show. So my highest conviction is I quite like large caps to some extent. And actually, it's a stock I've been critical of in the past, but actually going to 26, I'm pretty keen on Glencore. And the way I put it is I put it as 3 ways to win. The first one is the obvious one. Copper looks pretty good going into 26, obviously a record high price, but I think we're quite squeezy here, particularly the first few months. And I'm pretty keen. I think coal, we've bottomed and we should see progress on coal prices. And that's going to be pretty good for the company as a whole.
The second one, which is a bit more controversial, is I think we're finally seeing signs of an operational turnaround. And I think the new COO, Javier, has come in. He's been there 2 years now, and what we've seen at Katanga is signs of real progress. They've actually turned that mine around, and we're starting to hit proper grades. And if they can start doing that through the portfolio, I think we will actually, for the first time in a long time, see Glencore starting to hit some of those numbers. People are a bit disappointed about the Collahuasi guidance, but I don't think that's a problem. We know that. And I think we can see people get more confidence that Glencore is actually a mining company, not just a trader with some mines. And the third one is really aligned to that, is I do think we have M&A potential on both sides. I think they could sell some assets, and there's always a chance they do get acquired. We get some consolidation in the industry. So I just like the stock because I'm not just betting on copper or one thing. I think there's various factors that could drive this stock into 26.
I really have to bite my tongue from asking a follow-up there, George, but what is your most non-consensus prediction for 2026?
I think zinc. And that's really around the supply side. So obviously Antamina had a big zinc year this year, and that drops off next year. We go back from 450 to sort of 250 or so. And then Red Dog's coming off as well. Grades declining there. We're going to lose, I mean, a bit longer term, but 200,000 tons over the next sort of 3 years or so out of Red Dog. So you've got two of the largest zinc mines in the world basically coming off quite hard, and not much new coming on. I mean, some stuff, but not a lot. And I think zinc actually, it's done okay, but I think it could perform very well, really mainly from a supply point of view, assuming demand's okay. I think that could be, actually a commodity sneaks up. The only problem I have with zinc is it's not easy to play zinc from an equity point of view. They're either small or not that liquid. It does slightly help my Glencore point of view as well, I guess. But
yeah, one that certainly flies under the radar there. If we park up zinc and perhaps met coal, if you're sort of bullish on that outlook, is there another commodity that you're quite constructive about for 26?
Well, yeah, I mean, if I'm looking at commodities I'm constructive about, it would be rhodium. And I could say platinum as well, but I think rhodium has a chance. We saw 30,000 in 21. And we certainly, maybe not 30,000, but could see rhodium has done well this year, but could see it doubling into next year. And that's really more hybrids, longer range vehicles in China using rhodium. We've also seen the fiberglass industry in China try to substitute away from rhodium, and it failed. And they've had to come back in. That's what's driven sort of demand this year, but I see that continuing. And then I think on the supply side, obviously we know primary supply is hard, but the recycled supply, we're coming to that period. I'm old. If you go back, we're now coming to a period where car makers have thrifted rhodium out. So there's going to be less recycling coming through because there were low rhodium loadings in those cars coming to end of life. And in fact, if they were close to end of life, they all got recycled when we hit 30,000 in 21. So I think we've lost that higher rhodium catalytic converters.
I like the call, George. That was actually JD's call for last year, rhodium. So, great minds think alike. What's going to be the worst performing commodity for the year ahead?
So I don't think this is very, and I hate to say it, I don't think rare earths are going to do very well. I think that problem gets solved as we go through the year, maybe a bit early, but I think it's a very niche place. It's not something I've played very much, but I don't think rare earth prices are going to stay high forever. I think everybody's trying to solve that problem. So I would say rare earths. If I'm going to have another go, and this absolutely flies against my first pick, I do think, and I do worry that after a very strong first half, something could suffer second half is copper. And that is just if supply starts to come through and we get a slowdown in the world economy, then I think it could be vulnerable. But I'm bullish right now. But in a year's time, copper lower, I wouldn't be totally surprised.
Tom Solomon, Parlour Investments, mate, you've dialed in on your honeymoon in Bora Bora. I'm just envious. It looks beautiful where you are. But
we're stoked that you're thrilled to contribute to our predictions, even on your honeymoon. Thanks for coming in, mate. And what is your highest conviction prediction for the year ahead?
Thank you very much, guys. Great to speak with you again. What can I say? Enjoying life because I was not long honeymoon, but I am on my honeymoon. Look, if we go into my highest convicted idea through the year, it's actually Royal Gold, clearly supported by a constructive gold price outlook. I still see immense value across the sector, but I think royalty names have really underperformed here as a narrow sort of pool of capital has really chased what we chase sort of operational as well as financial leverage. Look, I think Royal Gold, I may be 6 months too early through a few of these. I may be 6 months too early when it comes to the royalty names, but I think they're going to be the key beneficiaries of the brownfield and greenfield expansions that we see under this higher gold price environment, especially as more generalist money comes into the sector. So although this pick may be a little boring for some of your listeners, I have been wrong on the gold price prediction before, and I think the risk reward looks very good here. Really, the main thesis behind this name is that since their Sandstorm since they announced to buy Sandstorm earlier in the year, they have significantly underperformed. Market did not like that this was not accretive on a per share basis when it actually comes to gold equivalent ounces. So although Sandstorm has a higher sort of MPV weighting towards these growth assets, the market did not like that. However, they've done 2 other acquisitions since then. The portfolio, highly diversified, remains 90% gold, silver. And compared to the largest peers, Franco and Wheaton, it's half the EV/EBITDA, twice the free cash flow, being the 3rd largest market cap of the royalties. It's even cheaper than a Cisco and Triple Flag. To sum it up, since the acquisition announcement in July, Royal Gold's up 13%, GDX up 55%, and gold up 27%. So that's that one. But look, I know that this is a little unorthodox, but given that name is so boring, and I do maybe want to take the win next year from the highest return, I'd like to propose another.
Give us the small cap.
Mate, a little bit spicy, and for those that can take the volatility, EQ Resources.
Oh yeah. Talk.
I'll keep the rationale short. I know a few of the other people there are talking down antimony and tungsten, but look, the new team headed by Craig probably has the most sort of pedigree within this niche commodity, and they've shown that they can turn these assets around. Spanish assets been free cash flow positive since the months of August and September. And Mount Carbine up in Queensland, they should be there in the March quarter, free cash flow positive as they reach the high-grade ore from the simple pushback. Now, look, tungsten prices, as we all know, they're up at 760 DMTU, up from 340 start of the year. Tough for me to bang the table to say prices go higher from here. But with China controlling 80% of the market, whether that's and they're having issues, whether due to quotas or mine issues, I think the geopolitical uncertainty remains, the defense requirement remains, and I struggle to see any other Western supply coming to market in the near term to ruin this for them. So these guys, they're going to be the largest Western producer shortly and generating significant free cash.
I like it. We haven't had a royalties pick just yet either, so that's a bit different as well, Tom. When you put your contrarian hat on and you think really non-consensus, what is the pick that comes to mind for next year?
Mate, I'm also hoping to win this pick as well as the most non-consensus, counter consensus.
We should make that an award.
Graphite.
Oh, okay.
That is.
Oh, yeah. I think I'm in for a running here. Now, I would like to be specific. This is US graphite anodes, is where I'm constructive. So I'm not saying flake graphite, which I know has burnt and is still burning a lot of Aussie investors. But to me, story's simple. With graphite, nearly half the weight of the battery is graphite, but everyone's focused on the cathode. And lithium started to move. Everyone's excited about stationary storage, just as positive for graphite. Look, demand for battery, so graphite battery demand is approaching next year, will be over 50% of graphite demand, up from 3% in 2020. So batteries are now having an outsized impact on this. And then if we look at the US, I mean, battery demand, or graphite demand for batteries is growing fourfold between now and 2030. So, and that's even before we put in those stationary storage figures. Look, then if you look at graphite anodes, 99% is controlled by China. This is the greatest analogy to rare earths and the MP deal that I've seen. So the West, we're not short upstream graphite. We're not short pet coke. We're not short flake graphite, but we're entirely reliant on Chinese processing technology, which is highly carbon intensive. So I think we do see a decoupling in those supply chains driven by both US trade policy and Chinese export control measures. In May, countervailing duties from the US announced. In July, anti-dumping. Effective tariffs on active anode materials are now 160% into the US. So this is not something that changes with a true social post. This is actually there. This is coming. And so to me, I feel compelled that this is the next sort of rare earths MP story. I'm also positive sort of picking this one because it's an opaque market. So it's going to be very difficult for you guys to say I was right or wrong. But look, I think there are only a few players that can provide this domestically or in friendly nations, and they're going to do deals with the likes of Panasonic, all of the cell manufacturers, the OEMs, and they'll meet in the middle of that 160% tariff to get our long-term offtakes.
What are those names?
Mate, Novonix, Nuvamond, look, Syrah is still there. They're having a few qualification issues with Tesla at the moment, as I'm sure everyone's well aware. I don't have a view on that. But look, there are a few guys that are really scrambling to do this. Talga as well doesn't have US production. But again, as long as you're not importing from China, then you should be a sort of indirect beneficiary of this.
Wicked, mate. And what about the best performing commodity for the year ahead?
Look, guys, last time I sat with you, I was bullish, yellow cake, uranium. I'm still there. So maintaining that call despite a bit of volatility. Look, clearly that story's been clouded a bit this year, given the development of the nuclear rather than the uranium trade, and a bit of a meme stock in a few of the names, such as Oklo and the like, which I'm sure have got attention from quite a few people. But look, if we look over the last sort of few months, downgrades in production from sort of Cameco at MacArthur River, Kazatomprom's 10% decrease on subsoil, Paladin, Boss, if you weren't aware, Honeymoon had an issue. But again, that is not now. Boss is actually performing very well. It's about the further growth and that sort of deficit and pushing that supply deficit further out. On the demand side, look, Trump gave executive orders supporting this in May. Most recently, the Westinghouse build-out. China's approved even more reactors, and on our numbers, they're going to be the largest buyer by the end of the decade. You've seen positive developments, India, Sweden. I know I can keep going. The other one is small modular reactors have been grabbing headlines. Although they require much higher initial feeding, they don't drive the market tightness on our model in the near term. So look, we've said it before, uranium is different from other commodities. Demand and consumption are two very different things. But we're extremely constructive on the premise that once Western utilities wake up to the fact that China is dominating this demand, that we're actually going to see market tightness. What came out of left field, and I'm not making excuses for our call, we did very well in the uranium and nuclear sector this year, but US utilities released 17 million pounds from the market. Okay, so that's eating into their current inventories and not replenishing that by buying in the market. So that's 14% of their stockpiles. Okay, so I think we're a spring coil waiting to happen once in this environment of energy security and primacy. And maybe all we need now, which I think is a very high likelihood, is the US announcing a domestic stockpile. I think Trump is supportive of nuclear, and that could come through, and maybe that's the catalyst to move us forward.
I'm really intrigued, Tom. And what about the worst performing commodity of the year ahead?
Mate, I actually struggled here. I was going to say iron ore, but I figured every man and his dog's jumping on Simandou, ramping up. Probably going to say that. So being the contrarian that I am, I'm going to say zinc. Look, this is more of a funding short rather than an outright bearish call. The market's in a small deficit this year. Mine supply and smelter production growing into next year, and that's expected to continue. But I think the main shift, China is switching from a net importer of 500,000 tons of refined metal to self-sufficiency next year, and even the possibility of exporting if the ARB actually opens up. So therefore, zinc prices could actually decouple from copper, and it could be a nice little funding short to use there.
Will Thompson, massive capital. Hope you've had a massive year, and we're delighted to get your predictions for the year ahead. Kick us off with, what is your highest conviction prediction for 26?
So
I don't have a lot of high conviction, sort of like general macro commodity sort of thematics. But I do think that Magna Mining, ticker symbol NICU out of Canada, will have a good year. And I do think Larvato, gold and antimony mine out in over with you guys in Australia, will have a good year. Both are going to be, putting mines into production or coming close, and growth, critical metals, etc. So I think they'll both have good, strong years next year. That would be my highest conviction. Two of the larger positions in my portfolio as well.
Couple of stock picks. I like it, Will. How about your most non-consensus view when you look in the market right now?
I'm going to go with, I think Global Atomic gets funded by the US government for their DASA project.
Is it coming before Christmas?
Before Christmas? I don't know about before Christmas. I'd love it before Christmas, but I'm thinking first quarter of next year. And I think they end up being the best uranium stock performance next year.
I like the call. And what is going to be the best performing commodity? Well,
I think it's actually going to be oil and natural gas, which is also probably non-consensus. Everyone's worried about the glut. I think the glut is more of a paper glut and paper surplus, if you will. Demand forecasts are conservative, could surprise the upside. Supply looks robust now, but years of underinvestment. And then, geopolitical risk, OPEC risk, etc. I think there's plenty of room for what is, in some regards, the most hated commodity right now to outperform next year.
Yeah, certainly hated, Will. And last but not least, what is the commodity that's going to perform worst over 2026?
So I struggled a little bit with that one. I'm actually going to go with a group of commodity producers. So I think rare earth metals will have a really rough go of it, or at least the producers. The metals themselves, different story, but I think 2025 rally was sort of poster child for loss-making, barely profitable at today's prices businesses, with investors paying growth stock multiples for highly cyclical, challenging commodity companies. So I think 2026, 2027. It's going to be tough years for rare earth producers. So,
Emmanuel, Dat Capital, we're delighted that you can join us before Christmas. I know things are very busy, but we're eagerly keen to hear what you've got in store for us. What is your highest conviction prediction for 2026?
Yeah, thanks for having us, Trav and JD. My highest conviction prediction for 2026 is a stock that we know well and we've spoken about in the past, WA1, which is absolutely making some amazing progress. We've seen in recent weeks the project being granted major project status, which we believe will significantly speed up permitting. And we've also seen on the sort of satellite imagery airstrip being knocked up on site very quickly. That will speed development. And the third leg to that is we've also seen the incredible metallurgical breakthrough of the production of niobium oxide from Looney's ore. I think what's really exciting us for 2026 is, we're seeing almost every month new applications and addressability of niobium in future-facing technologies. And to us, the world is just absolutely crying out for diversified supply to progress these advanced technologies. Things like niobium phosphide, which is a superconductor, niobium oxide, which is being, used in battery anodes. All these sort of elements really excite us. And I think that the question really comes down to, well, what's the value, right? And going back to something that you and JD have mentioned a few times, is that the value of a multi-generational asset cannot be captured in something as simple as a DCF model. So
I've seen the DCF models for Looney. It was that one that's online, mate. That looks pretty damn good.
Yeah. Well, the way I like to think of it is like, well, you've got a unicorn asset. So what's it worth if it's brought into production? Using something like Linus as a comparable, that brings you to about a 10x, in terms of EV. But ultimately, this, of course, is a function of time and capital. And look, I think that the market is also ignoring the significant downstream potential of the ex-niobium minerals that are present in the deposit. But we won't get too far into that, given the time constraints. So maybe that's a topic for another conversation.
Beautiful. I love it and appreciate you sharing the extra detail around what we can look forward to in 26. A ding, ding, ding on that part as well for us. What is your most non-consensus view for 26, Manny?
Yeah, sure. So it reminds me of an X post that I put out. That was a little bit of a double pun, and the only bond I trust is a hydrocarbon bond. And so I think that there's going to be growing realization, I believe, in Australia that coal will continue to be part of Australia's energy grid. I would say to at least the year 2100, unless we, of course, see a big shift in nuclear and nation building activities such as that. I think that ultimately, we are very lucky in Australia. We sit on an ocean of hydrocarbons, essentially. Yet we have some of the most expensive energy prices to the consumer in the world. I think it's a real travesty, that given affordable energy is the foundation of, advanced and progressed societies, that we as a nation are struggling with this. And, it all comes down to, the greenflation that we've seen over the past, 5 to 10 years and its effect on power transmission and all the rest of it. And I think also, secondly, a second interesting dynamic is that we've seen sort of a wage spiral really being driven by demographic change. And what I mean by that is we're seeing skill shortages due to people who are skilled leaving the workforce, and there are issues, with replacing their skills rather than, in the 1970s, we saw a similar dynamic. However, that was really driven by labor organization, unions, and all that sort of thing. So what this tells me is that we really need inputs to fall to maintain the quality of life that we enjoy today, basically. And that's why you should vote that for PM. So, sorry.
You got my vote, mate. What is going to be the best performing commodity for the year ahead?
Yeah, sure. So I think, I guess continuing on that same angle, we've definitely seen, tremendous financialization, I would call it, worldwide over the past 5 years or so. And I think it's really been only over this last 12 months we've seen that sort of real race of capital into real assets, for most prominently in precious metals. But also we're starting to see base metals starting to move a little bit. However, in comparison, energy has barely moved and indeed has fallen somewhat in notional dollar terms. So, this brings me back to that same 1970s analogy, where, over sort of that decade, energy was actually one of the best performing sectors. So, I think that there is significant scope for oil and other energy products to rise, and especially given the sort of many years of underinvestment in fossil fuels, driven by these sort of green ideologies, if you would, over the past 10 years. So I think that there's good potential there.
And is there a commodity you think's not going to do so well over 2026?
Yeah, sure. So I think that, we're expecting 2026 will be a year of geopolitical maneuvering, if you would. I think in the 1970s, we saw geopolitical fragmentation. We had the twin blocks of the Western nations and the Soviet blocs. Today, we're sort of seeing that in between the Western nations and Chinese associated blocks of nations. And I think that ultimately we think that, whatever commodity can be used as a political football or pawn, if you would, will be used in that sense. And so I think rare earths may be, a fairly weak sort of sector to be in for 2026, given, the Chinese so influential in that space, having, circa 90% of the production in hand. I think that despite the US attempting to diversify, rare earth supply, I think that there's a very good case for the Chinese just to absolutely drive down the rare earth price in the short term to sort of demonstrate or exert their sort of influence and power on this particular and very critical industry. So I think in a nutshell, 2026 will be a lot of fun, and we should really prepare for a volatile ride ahead.
Mr. David Franklin of Argonaut, the Natural Resources Fund and the Gold Fund, you've had an outstanding 2025 and you're our last predictor for the upcoming year. So we're very much looking forward to hearing what you've got to say. What is your highest conviction prediction for the coming year?
Yeah, look, so our highest conviction prediction is really probably a bit different to what most people have been saying. And that's, we just see a rise of passive ETFs, quant funds, market neutral funds, really changing the way the markets operate, right? So we just see that there's a lot more short-term focus, thematic investing, momentum investing, which is translating to increased volatility. And that's meaning that fundamental analysis and valuations are playing a lesser role, and that's certainly increasing volatility, as I was saying. I kind of liken it to a swarm of bees. What you've got is just everyone jumping on the same idea at the same time and really forcing up values really quickly. And what happened in lithium recently is a really good example of that, where the momentum just went very strong. People came in, forced up prices. And it didn't take long for the value to be sucked out of those flowers. I think really the opportunity for active investors like ourselves and like most of the people you've been talking to is going forward is to be looking for what is the next flower, right? So maybe being a bit ahead of the curve and focusing on those commodities and those stocks where that swarm is going to go to next. And I think that's really where active managers can make a difference in this kind of market.
The trend continues. What about your most non-consensus prediction for the year ahead, Dave?
Non-consensus or consensus?
Yep, non-consensus.
Non-consensus. Look, we think that iron ore will remain resilient. Iron ore is a commodity where the market always seems to be predicting a downturn, and I think it's the same kind of thing. With Simandou coming on board, people are expecting that supply is going to increase and impact on price. But I think in all likelihood, demand for iron ore will remain firm. High chance of production not meeting forecasts. And always the risk of weather impact on supply. So, we see the next year iron ore remaining sort of 95 to 105 kind of US dollars a ton. And I think that's good profitability for the majors, BHP, Rio, FMG.
Fantastic for Australia too, Dave. What about the best performing commodity?
So we think uranium. We think 2026 is the year for uranium. If you look at what happened in 2025, it has had its ups and downs, but in general, it was pretty flat. I think it ended pretty much where it started. Spot price is $76 a pound US and the contract price of 80. I think what you're seeing globally is just a demand for a carbon-free commodity which can provide base load power, and I think uranium is the one. And I think really what you're seeing and really what escalated over the last year is you've got all the major economies of the world moving on board. So you've got China very supportive, the US, the EU, the UK, etc. So I think uranium is in for a strong year.
And to wrap it out, the worst performer.
Worst performer, I think, is thermal coal. Really hard to see how it can perform particularly well over the next 12 months. The other factor is, what was going forward over the last couple of years is just the fact that you had a real cessation of any new developments in the thermal coal, particularly in the Western world. Whereas I think a lot of the attitude towards coal and particularly thermal coal has eased, and so you can see supply coming on, which won't help prices in the medium to long term.
What a diversity of opinions.
A real doozy. A lot of head-to-head.
Yeah,
it's
lots of
fantastic to
head-to-head.
see.
We're going to have to reveal our predictions, I think, in our final episode of the year.
Maybe we will.
Maybe
Stay
we'll have
tuned
to-
for that.
We'll have to see how we fared on our predictions last year as well.
If you're still listening, thanks for sticking around for a doozy of an episode. I hope there was a bunch of value in there. All thanks to Sandvik, Ground Support, Focus, the platform by Market Tech, Intralinks, Switch Technologies, and Exceed Capital in the show.
Sign up to the Director Special, Hoodaroo Money Minus.
Hoodaroo!
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.